Test, 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 test.
All right. Okay. Again, thank you everybody for coming. This next presentation will be on the opportunities and trends in real estate, specifically the market overview, the real estate cycles, as well as current industry trends. Today we are very lucky to have panelists DJ Van Kuren, who is the Vice President and Family Office Capital of Hyman Family Office, and Roman Bass, who is the Principal and Real Estate Investor of Real Estate and Investor Relations for the Carlyle. And without further ado, gentlemen.
All right, so today we're going to talk about real estate and some trends and where we feel that we're at. The reason we've got two of us up here is for a couple of reasons. One is that Steve had asked to sort of do this similar to some of the podcasts that I've done. And about 2 years ago, I had started USFamilyOfficeRealEstate.com as an educational platform that families can go to and get various answers to some of their questions, which I had put up there. And one of the things that we've done is we've done podcasts before, we've done industry experts, and we've talked about a variety of topics and trying to come from a family office position. So the last one we did was with Tom Handler, which I'd suggested a list to. It's really good on real estate law. And so that's sort of how we're going to do it today. So a little bit about myself. I've got about 25 years in the capital markets and 15 specifically in real estate. Managed a couple of real estate funds as well as worked for some pretty large developers. Actually, through that time, worked with some of your colleagues over at Carlyle Group when I was working with a lot of institutions. And then about 3 years ago, started in the family office space. And the family I was with, we'd been through a number of cycles, as well as myself. And so we'd really take a look at the various markets and the various assets of where we're at. And with the current family, we're in our third, our family's out of LA. And we're in our third area of wealth creation, which is on real estate. So we're continuing to build out our portfolio of real estate, and we do see that there's some opportunities. But what seems to be the case is that that's the question. Is there really opportunities or not? So today, as we'd mentioned, we've got Roman from the Carlyle Group. So Roman, why don't you tell me a little bit about what you do for them, a little bit about your background, and we'll go from there.
Great. Thanks for having me, and good afternoon, everybody. My background is in real estate. I've been in the sector for my entire career. Previously with CB Richard Ellis. They have an indirect investment arm based in Boston. So a lot of manager underwriting in private equity real estate. And have been with Carlyle for the last 6.5 years now, focused in global real estate. So taking advantage of having a very global view of the asset class and the different opportunities and the different trends that we see in the sector. So, like I said, whole career in real estate, a real estate junkie, if you will, for some people, but happy to share the views and outlook of the sector that we have.
Great. So, real estate is a very important part of a family office's portfolio, and the outlook that an institution take is a little bit different than the family offices. And the average allocation, and it's actually on a global basis for family offices, is about 15%. And, Cambridge, this is a good example up here that you can see that they show about their allocation. One of the biggest questions that I mentioned before is that people don't know where we're at, what's going on, the different asset classes, or really doesn't have that understanding because it is an area of expertise, right? It's an easier asset class to understand on some measures, but it's still one that they're not very, they don't know much about. So what's your view from Carlyle's perspective on the market overview, whether it's from residential to the various types of commercial? And we'll do that touching on some of the different types of assets.
Absolutely. It's a very challenging investing environment for sure. We think that we are probably in the later stages of the economic cycle in the United States. So finding opportunities for people like us that go for opportunistic returns and premium returns is a bit of a challenge. However, even though it's late in the cycle, there is still some runway in certain markets and certain geographies. The recovery post-global financial crisis has been a little bit uneven with respect to markets and different property types. So even though on what we call kind of the GDP-related sectors, those sectors that have a higher correlation with movements in GDP, which are basically office, retail, hotel, and logistics or industrial, those sectors are really, really challenging, and in most markets, and especially in the gateway markets, are priced to perfection. So for someone like us, that again, going after premium returns, we have been consciously avoiding those sectors and instead focusing in places where we think there's still runway and markets where there's still runway. And we believe those are the sectors that we kind of bundle under those that have a high correlation with movements in demographics. And we've been spending a lot of time in the last 5+ years really studying the trends in places like multifamily, senior living, student housing, self-storage, lab space, all these sectors in certain geographies, and if you do them in a certain way, we think there's still a little bit of runway. But again, going back to kind of the headline and what everybody reads, and just looking at cities like Chicago, where you see a lot of cranes around, it is definitely a very challenging investing environment. We think that kind of on the other side of the coin, if you know where to put the capital and how to structure transactions, and you can move quickly and be an efficient buyer and make a good fit for the portfolio, I think there's still some opportunity. Just in general, even though we all see cranes out there, as a general comment, development still, in terms of general and historic standards, still pretty low. We think that there's still a little bit of runway in places like student housing, multifamily. Those sectors still present some opportunity because the trough was so deep from that recovery, even though there's been quite a bit of development. Again, for historic standards, there's still a little bit of runway. For product, for example, staying with multifamily, since we're talking about that, for product that is being built today, but it's not delivered until, say, 2019, we think there's going to be positive absorption in that space. So we're still pretty bullish, even though we've done quite a bit in our previous funds. Again, if you pick the right place, if you find those pockets of demand, perhaps places where millennials are interested in living, those places still present a little bit of runway. On the topic of demographics, staying on the other end of the barbell, baby boomers is a huge driver of real estate and use of real estate. And so developing, call it age-restricted multifamily for that particular cohort is also another place where we see opportunity. Again, we can do office, we can do hotel. It's really late in the cycle for those property types in places like New York, San Francisco.
All right. By the way, one of the things that I like to do when I'm part of the panel is I like to open it up for questions earlier than later. So as I go through, I may ask, is there any questions? Because we're here for you guys. And so a lot of times that helps us take the conversation in a certain direction. Yeah. I will tell you this, however, is that this is going to be a very interesting discussion because there's a number of things that you say that, in all due respect from a professional perspective, I disagree on.
Of course.
So you're going to give some different perspectives. Now, first, let me ask you a question: is that what are the main markets that you guys are looking at? Okay. Because that's something that I don't think people understand, because we're coming from two different areas as well, because institutional investors usually have certain check sizes, right? And so you've got and certain mandates, certain hurdles. I know you guys are IRR driven, right? Yes. Some are multiple driven. So what are the markets where you guys usually focus on?
I would say traditionally, perhaps 2/3 of the capital that we've been putting out in real estate has been in the gateway markets, kind of the smiley face of the United States, Boston, New York, DC, down to Texas, and then up on the West Coast. As of late, places like Portland present interesting, compelling opportunities. Atlanta is also a place that we've been spending a lot of time developing property. Orlando, Florida is a place where we like the supply and demand dynamics in there. There seems to be a nice component of millennials going into that market. So I would say definitely not being able to take advantage of places like New York, San Francisco, Boston is also a little bit tough for us right now. So staying within kind of the gateway regional areas, we are picking our spots in the place that I mentioned.
All right, and what's the minimum check that you guys need to write?
So, contrary to perhaps the perception of Carlyle as a company, our average equity check for almost since the beginning of our investing history, which started in 1998, is only 18 million. So we go after what we call mid-sized transitional assets that are basically flying below, call it the institutional real estate radar.
And you said 18 million.
18. Okay. That's our check size, and then the total capitalization is probably 35 to 50 million when it's all with leverage and everything else.
But wouldn't you lever it up to very conservative existing asset, perhaps 70, 80 million?
Yeah, we usually stay very low on use of leverage. That's another, I guess, differentiating factor. Our average LTV for our previous 3 funds is only 49%.
But is that after refinancing, pulling out money, and then
floating? Yeah.
So when you go in, you're going to go at a higher LTV,
correct,
and then you're going to come out. So
license, yeah.
Yeah. So what that means? So the initial acquisition might be higher. So if we said 20 million, it could be an $80 million asset right. If you went in. But then after you refinance, you pull money out, you're back at a lower LTV.
That's exactly right.
So and this is something that's really, really important because that check size of 18 million, and it's usually in the 18 to 20 million from a lot of, whether it's Apollo or it's, some of the other Angelo Gordon, etc., is that there's certain assets that you have to look at. Right. Family offices, on the other hand, they're going to usually write checks anywhere. It could be $1 million, it could be $5 million, it could be $10 million, and so you're actually what we call, underneath that. We say institution because we're at 10 to 40 million, right? And we haven't ran across you guys necessarily in some of our markets, but it's more money than the country club money, what I like to call country club money. And you're going to typically get higher yields, and you're also going to be able to. A lot of families will look at secondary markets, where I ultimately think that people like you guys are going to end up there in order to get certain returns. And so, like, we're in Denver, we're in Austin, we are looking at Portland, Seattle, Salt Lake City. Orlando is a great market. One of the misnomers, and if you want some of this information later, I'm happy to give it to you, is that a lot of people say, well, you have more liquidity in these gateway cities. Well, there's actually some reports that was put together by a group out of Denver that shows that that's actually not the case. They're actually pretty correlated as a whole, and which is a lot of people don't believe that.
Right.
And then when you start looking at the data, you're like, oh, that's interesting. So there's 2 different investment philosophies here really as a whole, is that, they are going to, now your assets are going to be, you're going to have some pretty nice assets.
Yeah.
But once again, you're going to get another 1 to 2 basis points in these secondary markets and whatnot. So,
and then also, it varies by property type. The markets that I mentioned are more on the multifamily, what we call active adult, which is a subsector of traditional senior living. You will never see us buy an office building in Indianapolis, for example. If we don't think a market has liquidity for an exit, even though it might be an amazing deal, it's just not a market that we're going to be interested in. We want to make sure that we go in, go out, and that we have a deep pool of buyers at the exit, because we don't want to be stuck. And so you will never see us again buy. It could be a great Hilton hotel transaction in Indianapolis, but it's just not something that we're going to pay attention to.
And a lot of that has to do with the time frame, right? Because you are IRR driven, which is different for family offices, right? That's why a lot of this direct investing and co-investing, which is happening more and more with families looking for other families to invest alongside, is that it's more patient money, right? So you can actually be through, have a downturn or whatnot. You don't have to pull out. You guys have certain requirements where you've got to get in, get out, or whatever the case is. And in fact, we had purchased some assets from a fund back in, I think it was 08, 09, because they had to sell. Well, they didn't have a choice.
Right.
That was fantastic. So it definitely makes a difference from a philosophy, etc. Now, what I put up here is the typical investment cycle for real estate. And I'll show you here in a minute that we can actually go back about 200, 250 years and show that the same thing keeps happening, which in my opinion, we don't get any smarter because we continue to make the same mistakes, and that's the feds. and building and everything else that we do. And so this Dr. Mueller, who happens to be out of Denver, it came up with this, and he's taught this, and it's been one of those, he was the first person to really dive into the cycles about what happens in various components. And when we finish up, I'll give you my thoughts on where we are in the cycle as a whole with each asset class. So let's move toward that. Do you guys at Carlyle look at these cycles at all?
Oh yes, absolutely. It's tough to time the cycle when it's going to happen and how it's going to happen. You just have to assume there will be some sort of movement in general. The team, I guess one of the advantages of having a team that has been together for a very long time is you kind of see patterns, to your point, repeating themselves. We've been through two recessions already, the last one leaving a deep mark on the team. And back to my comment about use of leverage, liquidity at the exit, diversification by doing smaller deals and making sure that when we build a portfolio in a fund with the transactions, even if we have to return the keys of one asset because the business plan didn't pan out, our LPs shouldn't feel the pain at the fund level returns because we're properly diversified. And also picking the right sector, as I said before, being in multifamily, being in senior living, being in places where lower checks are required. You can take advantage of that. You're not tied to a big, office building on Fifth Avenue in Manhattan where all of the outcome of your fund is concentrated in the outcome of that particular transaction. All these little things that we do to help mitigate the risk and basically help us navigate the cycles accordingly, because the worst you can have is exposure to a big office over leveraged asset and you're caught in the wrong cycle with that asset and you have nowhere to hide. And so two prior cycles, a lot of lessons learned, a lot of risk mitigation exercises that we put in place with the different fund construction principles that we apply. But I would say we are we are obsessed almost with supply and demand dynamics, especially in the markets and the sub-markets where we operate. We want to know exactly who's building, where they're building, how they're building, when they're going to deliver. And if we don't feel it's the right place to invest, because we have a pretty large team, we have the ability to move around the U.S. and find other geographies or other property types that do present compelling opportunities. So it's not that we are purely kind of an office fund investor where that particular manager, regardless of the cycle, will have to put the money out in office throughout the 10 years. We are diversified by property type, and so therefore we can navigate the different cycles accordingly.
And that's another important thing too, I think, with families is that not only can it be long-term money, patient money, but also if it's not a good deal, you don't have to write a check, right? So for me, it's a little bit different than perhaps for you guys.
Yeah.
All right, is there any questions till we go on to the next part? Yes? So the question is, if I'm correct, are you talking like a 55 and older type community?
Yeah.
Okay, so like the baby boomers area, asking if there's less building that's going on, and how do you find those opportunities? Why don't you start, and I'll give you my take.
It is. It's probably out of all the different sectors that we're looking at right now, it's probably the one that we're the most bullish on. It's a very fragmented space to begin with. You have traditional senior living, which is dominated by the REITs, and then on the what we call it active adult, but it's basically age-restricted multifamily. We think it's extremely fragmented. It's mom and pops nationally, sleepy assets, sleepy management, and we have the opportunity to come in after a lot of due diligence, a lot of research. We actually spent almost 5 years studying the trends, supply and demand trends in the space before pulling the trigger. And when we did, we started with very small transaction and equity checks. It's tremendous opportunity. The average stay of someone that signs a lease for active adult or age-restricted multifamily is pretty long. It's usually 8 or 9 years. It's a person basically that sells their place in the suburbs and decides to move closer to downtown and entertainment. And that person is basically not ready to be in traditional senior living where you have 3 meals a day and you have medical staff present and so on. So that person has at least 8 or 9 years before they feel they have the need to go to traditional senior living, and they're not ready to go live in a property where they're sharing common areas with millennials. And so we've seen tremendous interest. We've been developing these assets for the baby boomer cohort, which is roughly 70 million people in the United States. And the trends, again, the supply and demand trends are just terrific. And it's a little bit tough to understand why nobody else or just a few other groups are jumping into space, because, again, out of all the property types, the supply and demand imbalance is very, very evident.
Okay, and we're going to come back to you in a minute, but this is where I've got a little different perspective. I think that anybody comes to me with apartments, and I'm running the other way. I think that there's a tremendous amount of oversupply, especially coming on board in the A properties. Now, I do think that there might be some opportunities in the B's and C's, but on the market rate apartments, that scares the bejesus out of me. And I think what's going to happen is a lot of those are going to be converted into 55 and older, because to me, that's the sweet spot. If somebody came to you or me and said, hey, we're doing a 55 and older apartment or an active adult community, I would jump on that really quick. When you start going into the space like assisted living, that's an operating business.
Yeah.
And it's just like a hotel. So you've got to look at that to make sure that there's a quality operator that's going to be doing that. From a cash flow perspective, long term, another area that I think is overlooked is affordable assisted living, where they're using Medicaid. Those you're not going to be able to exit in a short term, but they're going to cash flow like crazy. So I think that's the sweet spot. The part you're talking about, I think that's what's being missed right now, is in that area. Question?
Where generally are you seeing the most compression?
Cap rate compressions?
Just compression. Yeah.
Personally, I think it would be in the major markets like we talked about. You're looking at the New York. You're looking at San Francisco,
Boston, yeah.
LA,
areas in LA.
And that's why that's why a lot of these secondary markets. Now, the future growth that's projected over the next 40 years, the number one state is Texas, followed by Florida, and then it's really in the southeast where you're going to have long-term growth. And that's strictly from the aspect of affordability, right? People moving from one expensive area to another expensive area. And so you're seeing a lot of those cap rate compressions. Yeah. And when the interest rates start going up, it actually works on a push-pull method. So you're going to have price or the values go down from what you had because you can get less loan on the property.
And we see that we have a chief economist reviewing these trends all the time. The most compression has been in kind of the trophy, component of the property stock. In places like New York, trophy office assets, kind of in the corner, Midtown Manhattan, that has been having a lot of weight, and it's basically what we all read on the headlines and what gets the most publicity. But it's been a little bit concentrated in that really top tier, because there's a lot of 70% of the capital that was raised in the last 5 years or so has been in the core open-ended funds, and those those funds go after stabilized trophy assets, and that has been driving a lot of the cap rate compression there.
And we could spend all day on a variety of these topics. The one things I do want to touch on, because one of the biggest questions I always get with families who are hesitant right now to invest are where are we in the cycle? We can go back 200, 250 years. Cycles actually run on an 18 and a half year cycle. And what happens is, hold on, let me go to the next one here. So what happens is that you go up for a period of about 7 years. You're going to see a downturn for a number of years. It's going to go back up for another 7 years, and then we're going to hit another recession. So from our perspective, we see a downturn happen in 2019 with a lot of great buying opportunities in 20 and 21, especially on the multifamily side. And then we'll hit another recession probably around 2029, 2030, and we'll go back and we'll go ahead and repeat the darn thing again and again. And we've done that for, like I said, 250 years. So this is a good example of that. Now, where do we see where we are in the cycle with different asset classes? Contrary to my colleague, we see office is in the back part of the cycle. So apartment is way up there. Hotels, some opportunity, right? Retail is a whole other conversation we can have. I'll tell you right now, is that Amazon, if they finish that purchase of Whole Foods, it's going to change the whole dynamics. And there's firms that are going out of business as we speak. Now, this varies, as he had said too, is it's not only by asset type, but also by location. So this is an example here of apartments, of where various apartments are, because it's going to change geographically, also asset size. And this gives you an idea of where we see the various, and this is by Mueller as well. And I can provide any of these slides. You can give me a card.
One comment I would make about the inevitable recession that's coming, a couple of comments, I guess. We first of all, we don't think it's going to be real estate driven mainly. I mean, there will be an impact and there will be some pain to deal with, but this is not 2008. The lending markets have been somewhat disciplined, and you should always be careful when someone tells you that this time is different. But we do see that the lending community has held better standards than in the prior crash. So we think it's going to be more of a correction instead of a full stop recession. The recovery just has been uneven and very, very uninspiring. So it's not that we're coming from a very, very hot cycle in general, by and large. The other thing is we think it's going to be short in duration, and then it's going to be shallow. It's going to be kind of a quick reset situation, if you will, because again, we don't see some of the excesses that we saw in the previous crash. And that's why we don't think it's going to be mainly real estate driven. There will be some pain to deal with, but again, it's not going to be something earth-shattering like 2008.
Yeah, we see an 8 to 10 year runs. We got about 30 seconds here. So 8 to 10 year runs for housing. And actually, believe it or not, I was reading something the other day, but 66, the first millennial hit 31. And there actually are starting to go into the burbs as they start to get married. So they're projecting about 66% of those millennials are going to be moving outside the urban core. And that's where we are on the suburban office side, because companies can get better rates, lease rates, you got parking and everything else. And so that's where we see the opportunity. And then this is similar as the whole cycle, but like he said, he didn't even see the chart that we had on the 18-year cycle. It was the same thing. We're going to see a downturn. Lastly, I'll say there's a couple components that are very important we don't have time to cover, which is international capital. It is a conversation in itself, because the U.S. is now considered a safe haven for these investors, and real estate is a great place to go. So that's something that's impacting and will continue to impact. If they get rid of the 1031, which I hope they don't, that could have an impact as well. My hopes is that with Trump being a real estate guy, he's not going to want to touch any of that. But who the hell knows, right? I mean, everything we thought, we keep having changes.
We wouldn't be here if we knew.
So, in any event, if you guys want any of this stuff, this is the best clock I've ever seen, and then there's resources for you guys. So, thank you very much. Have any questions, you can ask either one of us. Thank you very much for being on the panel with me.
Thank you. Thank you for
and
having
thank
me.
you to Handler Thayer.
All right.
All right, can we get a round of applause for our panelists? All right, next we will have another panel coming up directly after this for opportunities and trends in alternative industries. So, specifically, the opportunities and trends in alternative industries panel will be discussing the mission.